It's on track for a weekly loss of about 6.2%. It looks like Biden's move to put more economic pressure on Russia has given some support to the market. Well, for more on this, I'm now joined by Alex Booth, Head of Research at Kpler. Alex, hi. Has the really soaring rise we've seen in the price earlier this week justified by the fundamentals, or are we seeing a kind of panic?
I wouldn't say it's exactly a panic at this point in time. We're really just putting a lot of risk premium into the oil price in the front of the market, because whilst the fundamentals haven't really changed at this point in time, it is becoming increasingly hard, or there's a risk that it's becoming increasingly hard to transact in this oil. Whilst legally you can buy oil, there's a reputational risk, a freight risk, insurance, financing. All of this is just really coming into play. So yes, we saw a lot of that heat come out of the market in the last couple of days. However, we think that we should still see a gradual tick up as the fundamental picture begins to evolve and people do see a bit of a shortage of oil going forwards.
After the US banned Russian oil imports this week, how are they going to fill that gap?
Well, from a crude point of view, the volumes involved are fairly small. The last couple of years, it's been around 100 kbd going into the US. That can be replaced relatively easily. Where they will struggle somewhat more is specific refineries in the Gulf Coast who have been using Russian feedstocks, the heavy feedstocks, to essentially replace the lost crude oil that they were getting from Venezuela, these heavy crude barrels. So this is why you're seeing development in talks, or kind of wanting for there to be talks between the US and Venezuela, with carve-outs to actually source or supply that heavier oil directly into the US as well as into the rest of the market. That's how they can kind of resolve the situation in the Gulf Coast. Doesn't really help the rest of the market and Europe, though.
Where does all this leave OPEC Plus? There was a jump, of course, in the price on Wednesday on reports that the UAE might be prepared to pump more oil despite the OPEC Plus agreement. Do you think all the member countries are going to stick to this agreement in the coming months, or is it going to start to fall apart?
Well, it's very hard for OPEC Plus to actually increase their production across all of the member states. So we could see the UAE and Saudi come with significantly more volume to the market, but the problem is that it will expose the rest of the countries and their inability to actually supply more crude. We run the risk that if Saudi and UAE go it alone, that actually we highlight that there is no more there is limited spare capacity from OPEC as a whole. And fundamentally, they also have to deal with Russia in the OPEC Plus agreement, who are going to be very hesitant to kind of permit additional supplies beyond the existing agreement.
With prices at this level, are we going to start seeing demand falling as Americans, for example, decide to drive their cars less?
So I think we have some way to go in terms of the US. We estimate that it's around the $5 a gallon level in terms of gasoline prices, where you'll see an actual change in consumer behaviour. But we're still comfortably kind of within the historical norms when we go back through kind of previous oil crises. When you're adjusting kind of real dollar terms, we still have a way to go. The issue is that if you look at the rest of the world in emerging markets, they're in a very different situation in terms of their post-COVID demand growth. The fact they're having to deal with emerging market currency devaluations relative to the dollar as well means that we could well see changes in consumer behaviour before we see that in the developed economies like the US.
Thanks so much for that insight. Alex Booth, Head of Research at Kpler.